Welcome back to another episode of a week's worth of news, where we break down the biggest business and economic news for the week. First up, we take a closer look at how currencies remain listless, as markets await clarity on potential Fed rate cuts. We'll explore what this uncertainty means for your wallet and investments. Next, we shift gears to oil prices, which are inching higher. What's driving this movement? It all ties back to expectations around the Fed's monetary policy. We also have some big news out of Asia. Bond markets in the region have seen massive inflows in August as hopes for Fed easing continue to rise. Finally, we turn to Canada, where despite early rate cuts, economic pain is still being felt across the nation. Stay tuned as we break down all this and more. The US dollar weakened against the yen, hitting its lowest level in over a year, as investors increasingly expect the Federal Reserve to announce an aggressive rate cut at its upcoming meeting. The dollar traded at 140.01 yen, as futures markets now price in a 60% chance of a 50 basis point cut. The anticipation of lower US rates, paired with expectations of higher rates in Japan, has strengthened the yen, narrowing the interest rate gap between the two currencies. Treasury yields have also dropped, with 10-year yields down 30 basis points over 2 weeks. Investors are selling dollars for yen, expecting the yen to continue strengthening. Meanwhile, other currencies like the British pound and euro are seeing slight gains, as central banks like the ECB and BOE are expected to take a more cautious approach to rate cuts. Let's break down what this all means. The market's focus is squarely on the Federal Reserve's upcoming decision, which is seen as pivotal in shaping the short-term future of global currencies. The Fed's aggressive stance on rate cuts signals growing concerns about the US economy, particularly the labor market. If the Fed moves forward with a 50 basis point cut, it could push the dollar lower, further benefiting the yen and potentially causing a ripple effect across other currency markets. On the global front, central banks are adopting divergent strategies. While the ECB and BOE are easing more cautiously, the aggressive Fed move could set the tone for broader monetary easing. If the Fed overestimates the need for aggressive cuts, it may risk stoking inflationary pressures down the line, which could complicate future policy adjustments. Conversely, a misstep in undercutting could lead to prolonged economic weakness. On September 16, oil prices rose by around 2%, fueled by ongoing disruptions in US Gulf oil production and caution ahead of the Federal Reserve's upcoming interest rate decision. Brent crude reached $73.01 per barrel, and US crude rose to $70.25. The market remains cautious as traders anticipate a possible 25 or 50 basis point rate cut from the Federation. A rate cut could lower borrowing costs, boosting economic activity and oil demand. However, a 50 basis point cut might signal deeper economic concerns in the US, raising fears about future oil consumption. Nearly 20% of crude oil production and 28% of natural gas output in the Gulf of Mexico remain offline after Hurricane Francine, keeping supply tight. However, concerns over China's economic slowdown persist, with weaker industrial output and retail sales dampening global demand expectations. Oil price gains are driven by US supply disruptions, but the Fed's decision will be key in shaping future demand. While a rate cut could spur economic activity and raise oil demand, signs of economic weakness in the US could limit these effects. Meanwhile, China's sluggish growth remains a concern, as continued weakness in the world's largest oil importer could offset any demand boost from lower US rates. As a result, the oil market remains highly sensitive to both supply constraints and global economic signals. In August, Asian bonds saw massive inflows, with foreign investors injecting $14.06 billion into regional markets, the largest monthly figure since at least 2019. The surge was driven by growing optimism that the US Federal Reserve will start cutting interest rates in September, a shift that could pave the way for central banks in Asia to follow suit. South Korean bonds led the inflows, attracting nearly $6 billion, the highest since May 2023. Indonesian bonds continued to perform well, bringing in $3.5 billion, marking the fourth consecutive month of gains. Investors also poured into India, Malaysia, and Thailand, with inflows of $2.14 billion, $2.06 billion, and $370 million, respectively. The consistent investments across these nations reflect confidence in their bond markets amid hopes of a global easing cycle. Traders are betting on a sizable rate cut from the Federal Reserve this week, driven by concerns over the US labor market. This anticipated move by the Fed has also led to speculation that Asian central banks may reduce rates in response. The Philippines has already cut rates by 25 basis points in August, and analysts expect Bank Indonesia and the Bank of Korea to join the easing trend once the Fed takes action. These inflows underscore growing confidence in Asian markets, as lower interest rates make bonds more attractive. If regional central banks follow the Fed's lead, it could provide further support for Asian economies by lowering borrowing costs and stimulating investment. However, there's a balancing act here. Aggressive rate cuts could spur inflation or weaken currencies, especially in emerging markets. Investors will be closely watching how quickly and aggressively these central banks move in response to U.S. monetary policy shifts. Despite 3 interest rate cuts since June, Canadians continue to face significant financial pressure. While the Bank of Canada has reduced its key rate to 4.25%, many consumers are feeling more stressed than their U.S. counterparts, largely due to differences in mortgage structures and rising rents. Most Canadian mortgages are variable or fixed for just 5 years, meaning homeowners are more vulnerable to interest rate increases when their loans renew. With a large wave of mortgage renewals coming in 2025, many Canadians could see their payments rise, despite recent rate cuts. Renters are also struggling, as landlords, facing higher mortgage costs themselves, are increasing rents. In July, Canadian rents surged 8.5% year-on-year, further squeezing disposable income. Population growth, driven by immigration, is also contributing to rising housing demand, adding to rental pressures. Adding to this strain is Canada's high household debt, which exceeds the size of its GDP. Before interest rates began rising post-pandemic, Canadians were already heavily indebted. Now, they're allocating about 15% of their disposable income to debt servicing, compared to 10% in the US. Even with these challenges, Canadians are saving more to manage debt, with the household savings rate reaching 7.2%, while Americans are spending more, with their savings rate at just 2.9%. This stark difference reflects the unique challenges facing Canadian consumers, who are cutting back on spending to stay afloat. The economic pain in Canada, despite rate cuts, reflects deeper vulnerabilities tied to high household debt and an unstable housing market. The Bank of Canada's early easing hasn't provided much relief, and with more mortgage renewals on the horizon, financial stress may persist into 2025 and beyond. Policymakers will need to balance managing inflation with offering meaningful relief to heavily indebted households, but with high debt levels, any aggressive rate cuts could risk inflation or fuel further instability. Includes another episode of A Week's Worth of News. Join us next time when we recap all the latest news in business and economics.